I love bringing you market insights, and yesterday we got to hear from Dominic from the Federal Reserve Bank of Atlanta, and he shared a couple of really great tips. So I recorded them, and I thought I would share them with you. One of the questions he's going to answer is, what is happening with the interest rates in the near future? And the other question he's going to address is the market like 2008, and how does it compare? Hey, check out what he has to say.
Not asking you to predict what the Fed's going to do, because you wouldn't answer that question, but but what kind of do you see potentially in 2024 from that fixed perspective if we have some better control on inflation? Are you looking at something that's going to move into a better affordability? And many of you all know the phrase marry your house but just date your interest rate. And I wanted to see if you had any insights from a interest rate perspective you're allowed to share with us without getting in trouble.
Yeah, so I think that as I mentioned earlier, and as the first speaker mentioned, we're still not seeing the level of contraction and inflation that would warrant less stringent monetary policy. So translation is, we're not seeing the economy slow enough to warrant us to lower interest rates. And a lot of people expect that there's a famous dot chart that shows where the members of the Federal Open Market Committee think that rates are going to go over time, and then and then you compare it to where the market thinks rates are going. And when you look at where the Federal Open Market Committee, that's the Board of Governors and the Fed presidents that decide where interest rates are going, they tend to think interest rates are going to stay higher a little bit longer, where the market thinks that rates are going to decline. And the difference between the two perspectives is that the market is baking in, at least they were baking in, some sort of recession. Because when there's a recession, then the Fed will have to pull back on rates. We just don't see currently, now this could change, later on this year, moving into next year, but the level of economic growth, you heard earlier, the GDP now projection of growth moving forward is pretty strong. Job growth remains very healthy. All of those things indicate that, the economy is not slowing enough in order for us to see some sort of decline in rates. Now that could change. It could change in either direction. Inflation could go back higher, or it could go lower. But we just don't. It's just not there yet. And so sorry to be a Debbie Downer. But I do think one of the things that I guess we're all aware of is how the market is sort of adjusting. So rate buy downs are becoming sort of the go-to way to create some sort of a level of affordability for buyers. I talked to one builder a few weeks ago, and he was telling me that per house, he sells somewhere between $350 and $450 is sort of his average price house, and per house he's spending about $35,000 just for rate buy downs. And if he didn't offer that, a lot of his buyers wouldn't qualify. And so that's sort of where we are in the market. And until we see slower economic growth, we're probably going to see elevated interest rates for the near future.
Well, maybe this question for you is not so doom and gloom. So we're seeing contracting sales today in a very similar pattern as to 2008, which is a little scary if you're looking at it from that very small view of the economic factor. But what is your perspective on the comparison of the contracting sales in 08 compared to what we're seeing similar in contracting sales today?
Yeah, it's night and day. So I was around in 2008 and remember sort of the sky is falling. And I think sales contracted nationally around about 20% year over year. Recently, over the past year, the sales contracted by almost 30%, so much higher, like a sharper decline. If you told me that home sales are going to decline by 30%, I would think home prices would collapse. You would see, for foreclosures all over the place. That's not happening at all, and everyone knows why, right? Because we just don't have enough inventory. Compared to 2008, when sales declined in 09 and in 2010, the month supply of inventory jumped to over 10 months. Today, nationally is at 3. Atlanta, we have a 2-month supply of inventory, and that's the big difference. The reason for that, of course, is the golden handcuffs. Everyone is sort of locked in at their rate. It's a disincentive to sell. And so that's the big difference. The other difference is, I remember the build up to 08, about a third of mortgages that were originated had a FICO score of that would be considered subprime. Today, over the past year, particularly in this increase in sales during the pandemic, the 80% of all mortgage originations had FICO scores of 720 or higher. So we're pretty much not doing any of those low credit quality borrowers. Number one, there just aren't homes for them to buy. The more affordable entry-level homes don't exist anymore. And there's just been the dominance of the market by people that are in better credit positions. And that created that wave of foreclosures in 08 that we just don't see happening right now. The level of mortgage delinquencies remains very low. Foreclosures, I mean, it's inching up a little bit, but it's still very, very low. The other thing last thing I'll mention is the big difference between now and 08 is we have created a more vibrant, secure single-family investor system that didn't really exist. There's always been single-family investors, kind of mom and pop, but it's more institutionalized now over the past 10 or 12 years since the last housing crash. In Atlanta at the peak, around 30% of our home sales in the region were to investors. Now that's come down since rates have gone up, but it's still around about that, 20% of sales are to investors. And that just didn't exist in 2008. In fact, that institutionalization of investors really was created out of that downturn, because now you were able to acquire a large portfolio of foreclosed properties. And so all of that has sort of helped us maintain a floor. And so inventory remains very low. We still have good credit quality borrowers. We're not seeing a whole lot of foreclosures. Credit is a little tight, but not significantly tight like we saw in 08. But yes, it's a night and day situation.
Thank you. So we've got about 5 minutes left.
As always, we are super excited to bring you the latest and greatest real estate insights.